Hello, my name is Santiago Kausman, and today I'm going to be talking about secondary mortgage markets, what they are, who are the parties involved, as well as the current situation and future possibilities in this market. Okay, so let us get us started. So, what is it? The secondary mortgage market is a market that allows banks and investors to buy and sell mortgages. So that being said, um, we have mainly three parties involved in this market. And the parties involved are the originators, the aggregators, as well as the investors. And we'll go and discuss what each of these parties do. So the originators are the loan grantors. So let's use an example. Let's say that I want to go and get a house loan and get my first house. So I go to the bank or I go to a financial entity that will issue a loan and I ask for, let's say, 250 grand in the loan. So this bank or financial entity will see if I'm worthy to get this loan. And if I am approved and I'm worthy, I will get it. So these banks or financial entities are the loan grantors. These are the originators. And once they get, let's say, a bundle of mortgages, so banks or financial entities start to grant loans to people, they need they need cash in order to pay for these loans. So they accrue this debt, and there are some banks that they have deep pockets and they can afford it. There are some others that cannot do that. So that's why we have a secondary mortgage market. So these banks that cannot afford having all this debt, they decide to move and sell bundles of mortgages to other companies or enterprises or bigger banks so they can have more cash to create new loans. So the aggregators are the enterprises, banks, or financial entities that buy. So we can see here in the picture, they buy loans from different places and they create bundles. So they give cash to the originators or so they can build new loans for other people, and they have these bundles which they will be selling to investors. So the investors are mainly companies, banks, people that they buy parts of these mortgages, and that's how they keep funding to a lower level so these originators can have new loans and have more people getting them approved and having, let's say, credit card loans, car loans, etc. So the current situation in this market, the industry is growing after the recession in 2008 and 9. There was a lot of money lost in this market. So the investors started to pull out money, and now that's starting to get better. We have an industry growth, especially from 2013 to right now. Why? The reason is because we have more or less fear-driven investors in banks since the economy is getting better. And by having more loans, consumer debt is rising, which means that people can get access to more credit card loans, and then this will boost the economy. So future possibilities, the future possibilities and opportunities that we have is that because because of this growth and then in the market and people getting more credit card loans and other kind of loans, we have an accessible or accessibility to personal loans and car loans and house, etc. As well, we have more investment opportunities if we're trying to be the investors, and we have a stronger economy since people are boosting the economy in by funding these loans. And as I mentioned before, we will have a higher credit card debt, which is bad, but if you know how to use it in your favor, it could be beneficial. Thank you.